Welcome to this Talk Ticker style deep dive. Our mission today is to just really crack open the Q2 2026 earnings call for Atlanticus Holdings.
Ticker symbol ATLC for those following along.
Right, ATLC. And the goal here, as always, is to take all that dense Wall Street consumer credit jargon, translate it into just plain English, and give retail investors a really clear, actionable verdict on the stock.
Yeah, cut to the noise.
Exactly. So to start, just a quick overview for those who might not be super familiar. Atlanticus is a consumer finance company. They're actually celebrating their 30th anniversary right now, which is, pretty wild in this space.
It's a long time to survive in consumer credit.
It really is. And they're primarily known for offering credit to everyday, often lower income Americans. They operate heavily in the second look space.
Right, the second look programs.
Right.
So just to clarify that for people, that's like when you go to buy, say, furniture or get dental work, and the primary bank lender declines you.
Right. You get the dreaded, sorry, we can't approve you.
Yeah, exactly. Atlanticus steps in right there as the second option to evaluate and potentially offer you that credit.
Yeah, so it's a crucial part of the economy, but, obviously comes with its own risks. And that brings us to the hook for today, because ATLC just dropped an absolute monster of a quarter.
Oh, monster is almost an understatement.
Seriously, they completely digested this massive acquisition, which we'll get into, and they just shattered their own profitability targets while doing it.
Yeah, they really did.
But, with consumer debt always being a huge headline worry, like every time you turn on the news, it's consumer debt is peaking. The big question is this growth actually safe?
And that's the multi-million-dollar question, right? Or $1 billion in this case.
Right, billion. So let's jump right into the headline numbers because they absolutely smashed the targets.
Let's hear the data.
Okay, so the raw data. Revenue came in at $744.3 million. That is an 89% increase year over year.
89%. Just let that sink in for a 30-year-old financial firm.
Yeah, it's not a software startup. It's a mature credit company. And the EPS, the earnings per share, was $2.50 just for the quarter. Net income was $47.4 million, which is up 67%. But the number that really made my jaw drop was their return on average equity, their ROAE.
Oh, yeah, the 28.1%.
Or 28.1%. Like, I have to frame this for a second because management's stated long-term goal for ROE is 20%, right?
Right, which is already a very aggressive elite benchmark in the financial sector.
Yeah.
Most banks are thrilled with like 12 or 15.
Exactly. So hitting 28.1% isn't just, beating expectations. It's honestly like a student who normally aims for a solid B, and then they accidentally break the entire grading curve and get 140% on the final exam.
Yeah.
It's absurd. So explain the why here. Like, why did these numbers explode so violently to the upside?
Well, there's a couple of factors. I mean, first, to be fair, it wasn't just the acquisition. Their legacy receivables, the loans they were already making, did grow by 26% organically.
Okay, so strong baseline growth.
Very strong. But the real rocket fuel here, the thing that broke the grading curve, was the successful integration of Mercury.
Mercury. Okay, break that down for us.
Yeah, so Mercury is this major consumer credit card portfolio that Atlanticus acquired. And typically, when a company announces a massive acquisition like this, the market kind of braces for impact.
Right, you expect them to stumble a bit.
Exactly. You expect the acquiring company to look sluggish for a few quarters. They have to, graft this massive new apparatus onto their existing operations.
Merging tech stacks, dealing with different company cultures.
All of that. The friction almost always shows up in the margins, and you anticipate integration costs spiking. Management usually basically asks investors for like a year of patience while the dust settles.
But that didn't happen here.
No, it didn't. They took on this massive integration, and instead of slowing down, the financial velocity of the company actually accelerated.
Right.
They just pulled off a textbook case of asymmetric execution.
Wow. Okay, so massive top-line growth, successful M&A integration, that's all great. But we need to talk about the elephant in the room. Because in the credit card business, lending money is easy, right?
Oh, giving it away is very easy.
Yeah, getting it back is the hard part. So what is actually happening under the hood with their loan quality? Because this is subprime we're talking about.
Right. Let's translate some of the jargon here.
Yeah.
The company currently manages $6.9 billion in unpaid loan balances. They call that their managed receivables.
$6.9 billion.
And their combined principal net charge-off rate hit 17.7%.
Wait, hold on. Stop right there.
I knew you were going to flag that.
I mean, 17.7%, that means nearly $1 in $5 they lend out is just gone, written off as a complete loss.
Yes, formally recognized as uncollectible.
To a retail investor, that sounds absolutely terrifying. I mean, if a traditional bank had an 18% charge-off rate, regulators would be locking the doors. How is a company writing off that much debt while still posting record profits and a 28% ROE? It doesn't make sense.
It sounds totally contradictory, I know, but you have to completely detach from the prime lending paradigm to understand this.
Okay, detach how?
So if you look at a standard credit card issued to a consumer with, say, an 800 FICO score, the issuing bank models for a loss rate of maybe 2% or 3%.
Right.
In that model, if your losses suddenly spike to 10%, you're dead. It destroys a profit margin. But in subprime lending, a high charge-off rate isn't an operational failure. It's actually a foundational, mathematically anticipated input.
Oh, so it's baked into the cake from day one.
Exactly. It's all about the unit economics. The shock absorber in this equation is the yield. By underwriting consumers with thinner credit files or, historical delinquencies, Atlanticus is taking on quantifiable risk.
And they charge for that risk.
Heavily. They balance that risk by charging significantly higher interest rates and using different fee architectures.
So basically, the model dictates that the yield generated by the 82% of consumers who do pay their debt, that yield has to be high enough to not only cover the principal loss to the 18% who default, but also pay for all the operations and still kick out a 28% return on equity.
That is exactly how the math works.
Wow. Okay, but still, 17.7% seems high. Is that number getting worse?
Well, the 17.7% is actually a sequential increase from the previous quarter. But, and this is crucial, it's due to normal portfolio seasoning.
Seasoning. Okay, that sounds like we're cooking, but I know it's a finance term. Explain seasoning.
Sure. Seasoning essentially means that a newly minted batch of loans always looks completely pristine on day one.
Because no one defaults on the first day they get the card.
Exactly. The consumers who ultimately intend to default or who just lack the capacity to pay don't usually do so in month one. The defaults surface later, creating what we call a predictable vintage curve. As a specific block of loans ages past the 6 to 12 month mark, the charge-offs hit their mathematical peak before the portfolio finally stabilizes. And because Atlanticus has been growing so fast recently, they have a huge volume of new loans currently hitting that exact peak seasoning window.
Oh, so the sequential rise from last quarter is just a function of their aggressive growth, not necessarily that the consumer is suddenly falling off a cliff.
Precisely. It's just the math of the vintage curve playing out. And here is the kicker. On a year-over-year basis, that 17.7% is actually an improvement.
Wait, it's lower than last year?
Yes, and that is entirely thanks to the Mercury portfolio having lower historical losses than Atlanticus's legacy portfolio.
Right.
By blending the two together, the overall credit quality mathematically improved.
Okay, that makes sense. But, we can look at their internal math all day. Does Wall Street actually buy this? Are the big institutional players worried about the 18% loss rate?
Not even a little bit. And we know this for a fact because Atlanticus just achieved its first ever AAA rating on its asset-backed securities, or ABS.
Okay, a AAA rating, that's a huge deal. Let's translate that for the listeners. What is an ABS, and why does a AAA rating matter so much?
An asset-backed security is created when a company like Atlanticus pools thousands of these individual subprime loans together and basically tranches them into bonds to sell to big institutional investors.
Right, like pension funds and mutual funds.
Exactly. And the rating agencies, whose entire job is to ruthlessly price risk, look at the cash flows from these pools to determine how safe the bonds are.
And AAA is literally the highest safety grade you can get. It's what U.S. Treasury bonds get.
Exactly. The smartest credit rating agencies in the world looked at ATLC's loan pools, saw the 17.7% default rate, and still gave the senior bonds the highest possible safety grade.
That seems wild. How do you get a AAA rating on a pool of debt where 1 in 5 people won't pay?
Over collateralization and structure. They essentially put more loans into the pool than they issue in bonds. So if they sell $100 million in bonds, they might back it with $120 million in loans. Plus, the high yield we talked about generates massive excess cash flow every month.
Ah, so the bondholders are shielded.
Completely shielded. The rating agencies stress test it, modeling severe recessions, and confirm the senior bondholders will still get paid.
And for ATLC, getting that AAA stamp means they can borrow money at much cheaper rates, right?
Yes, tighter spreads. It massively lowers their cost of capital, which just widens their profit margin even further.
Okay, so funding is totally secured. The bond market loves them. Let's talk about the other side of the business, finding the actual customers, because there's a huge marketing shift happening here.
This is one of the most fascinating parts of the call.
Yeah, so Jeff Howard, the CEO, gave this revealing look at the industry. Apparently, direct mail solicitation volume, the literal junk mail credit card offers stuffing your physical mailbox, was up 50% industry-wide.
50%. That is a massive surge.
I mean, I've noticed it. My mailbox is just full of pre-approved offers lately.
Same here. And when every lender floods the physical mailbox simultaneously, what happens? Consumers just become numb to it. They throw it straight in the recycling bin.
Right, the response rate plummets.
Which means the cost to acquire a single activated customer through direct mail becomes incredibly expensive. It's a highly inefficient use of capital right now.
So what did Atlanticus do? Did they just eat the higher costs?
No, they smartly pivoted. Howard openly acknowledged that direct mail economics were breaking down. So they accelerated their customer acquisition through digital origination channels instead.
And it worked, right? They added a record number of customers.
A record 790,000 new customers in the quarter, primarily by beating competitors in the digital space.
790,000, that's huge. But wait, is shifting from direct mail to digital really that hard? Can't you just take your mail flyer and make it a Facebook ad?
Oh, absolutely not. The behavioral physics are entirely different.
How so?
Think about it. The data points you get from a consumer who opens a physical envelope, fills out a paper form, and mails it back are very static. It's a slow, deliberate process. But a consumer clicking a targeted digital ad on Instagram or a financial comparison site at 2 a.m., that generates a completely different behavioral footprint. The fraud vectors are different, the velocity is different, the intent signals are completely distinct.
So you need totally different algorithms to figure out if that person is a good credit risk.
Exactly. You cannot apply a direct mail underwriting model to a digital click. Atlanticus had to build channel-specific underwriting models and deploy proprietary analytics tailored solely for digital interaction. And clearly, those proprietary analytics are firing on all cylinders.
Okay, so funding is secured, digital marketing is crushing it. With all that working, what is management telling us to expect for the rest of the year? Let's get into the management guidance and the macro risks.
Yeah, so looking ahead, the first big milestone is the future of Mercury. Management expects the full tech integration of Mercury to be completed by mid-Q1 2027.
Okay, so early next year.
Right. But crucially, they are already 90% done repricing the Mercury assets.
Repricing, that means they're changing the terms on the customers they acquired, right?
Yes. Remember, they bought this portfolio and they only want to keep the accounts that meet their high return targets. So they have to raise rates or adjust fees on a huge chunk of these Mercury customers to fit the ATLC model.
Which is risky, right? If you tell a customer, hey, your APR is going up, they might just close the account or worse, just stop paying.
It's very delicate. But Howard confirmed the repricing is going incredibly well. They are shifting Mercury from a portfolio that was just slowly paying down and liquidating into a dynamic growing asset that actually hits their yield targets.
Okay, that's the internal operational side. But what about the outside world? What's their macro view on the consumer right now? Because subprime consumers are usually the first to crack if the economy weakens.
CEO Jeff Howard actually isn't panicking about the consumer at all.
Really? With all the recession talk out there?
He noted some very specific foundational data. Unemployment remains historically low, which is the biggest driver of repayment. If people have jobs, they generally pay their bills.
That makes sense.
And he also pointed out strong, real wage growth. And specifically, wage growth for lower-income consumers has actually outpaced other segments recently.
Oh, that's interesting.
Yeah, so their core demographic technically has solid purchasing power, which supports stable credit behavior.
But it can't be all sunshine and rainbows. What are they worried about?
They are keeping a very close eye on two things: above-target inflation and volatile gas prices.
Gas prices, that's huge for the subprime demographic, right?
Massive. Gas prices function almost like an immediate regressive tax on lower income cash flows. It's an expense you can't really plan for or avoid if you have to drive to work. When fuel costs spike, it directly drains the liquidity a consumer might have used to make their minimum credit card payment.
So if gas hits $5 a gallon, ATLC feels it in their delinquency rates almost instantly.
Exactly. It's a key pressure point.
Which brings us to the CFO, Bill McCamey. He gave a pretty explicit warning on the call, didn't he?
He did. He explicitly warned investors that delinquency rates may increase modestly next quarter.
Okay, so if I'm a retail investor and I hear the CFO say delinquencies are going up, my instinct is to hit the sell button. Is that a massive red flag?
Actually, no. It's not a red flag at all. It's just math.
Just math. Explain.
It goes back to what we discussed earlier. It's due to having a full quarter of the Mercury portfolio on the books, which changes the denominator of the calculation and the faster growth in their legacy portfolios.
Ah, the seasoning curve again.
Exactly. All those new loans they just originated are hitting their peak delinquency window at the same time. The structural math dictates that delinquencies will rise modestly. It's planned for, modeled for, and completely expected by management.
So don't panic when the headline next quarter says delinquencies ticked up.
Right. As long as it's within their modeled range, the business is functioning perfectly.
All right, so taking all these data points together, the explosive 89% top-line growth, the AAA bond rating lowering their borrowing costs, the successful digital pivot, and this measured macro outlook. What is the final verdict here?
The bottom line for retail investors.
Yes, the bottom line. Let's make it actionable. We'll take a stance here. This earnings report is a very strong, heavily bullish signal for the stock.
I completely agree. It's a fiercely bullish report.
And the why for investors is that Atlanticus is just giving an absolute masterclass in M&A execution. Buying a massive portfolio like Mercury could have easily sunk them. It could have dragged down earnings for 2 years.
It happens all the time in corporate finance.
Right. But instead, they digested it flawlessly, optimized the risk profile, and it actually boosted their return on equity to an unbelievable 28.1%.
Yeah, it's just phenomenal execution by the management team.
So what should investors be watching for next? What's the catalyst that could push the stock even higher?
The biggest thing to watch is what management does with all this cash they're generating. On the call, they noted that while ROE might eventually revert closer to their 20% target as they naturally pay down some debt, if it stays up in the high 20s for a while, they might pursue what they called capital actions.
Capital actions, that's the magic phrase. That usually translates to share buybacks or initiating a dividend, right?
Exactly. Returning value directly to the shareholders. If a company with a 28% ROE starts aggressively buying back its own stock, that creates a massive structural tailwind for the share price.
That is definitely something to keep on the radar. But before we wrap up, I want to leave the listener with a final provocative thought, something to kind of mull over as they evaluate the long-term story here.
Lay it on us.
Okay, so ATLC is absolutely thriving right now because they outsmarted their legacy competitors. While everyone else was stubbornly flooding physical mailboxes and paying astronomical direct mail costs, ATLC pivoted to digital marketing and scooped up 790,000 customers on the cheap.
It was a brilliant tactical maneuver.
It was, but tactical advantages are rarely permanent. Eventually, the rest of the industry is going to figure out that the mailbox is dead, and when they do, they're going to take those massive marketing budgets and flood the digital ad space.
The great migration online.
Right. So as digital advertising inevitably gets saturated and the cost of a click goes up, just like the cost of a stamp did, the question is, can Atlanticus's proprietary analytics keep their customer acquisition costs low enough to actually maintain that massive 28% return on equity?
That's the real test.
Yeah. Or is a margin squeeze just inevitable once the big banks start bidding against them on Instagram and Google?
It's the classic innovator's dilemma. They won the first battle in the digital space, but the war is just starting.
Exactly. It's a fantastic quarter, but that digital bidding war is the long-term tension every investor needs to watch.
Absolutely.
All right, that's going to do it for this Talk Ticker's deep dive into Atlanticus Holdings. Thanks for joining me, and we will catch you on the next earnings breakdown.